Hello guys, welcome back again to ESENtaxa. Andrea Papito here. In this video, I'm going to explain you the concept of the double taxation. If you're new in this channel, ESENtaxa talks about how to optimize the taxation, focusing on Italy, and also we are going to explore the rest of the country in Europe nowadays. And the idea is to help you guys to understand what is the best way to exploit the taxation in a certain country, optimize your taxation, and plan a long-term tax residency in order to spare your taxes and reduce them as much as possible. In the description below the video, you can contact us at info@esentaxa.com and you can see our services in our website www.esentaxa.com. So in this video, I want to explain you the concept of the double taxation because this is something that is quite important to understand. A lot of people are unaware about these topics. But it's one of the most important concepts that you have to know, especially when you move from a country to another country. And in that specific year, you're obliged to declare taxes in both countries, okay? Most of the cases, okay? It's not always the same situation, but in most of the cases, you are required to change your fiscal residence in another country, and the new country requires you to declare the other income that you have earned in your country of origin, okay? So this is the point. And the double taxation actually, it happens when the country in which you reside requires you to pay taxes on your entire worldwide income, okay? And the country where you are generating your income requires you to pay taxes locally. I'm going to explain you exactly this concept. And this concept is common in every agreement signed between countries to avoid the double taxations, okay? So let's first a little bit focus on this concept, and then I'm going to explain you which are the methods to avoid the double taxation. Okay, the classical situation is when, for example, we are living in a country A, and in the country A we are earning, let's say, some employee income, okay? And then we are moving to the country B, okay? In the country A, maybe we also have real estate under rent, okay? So we have also real estate income. Then we receive a job offer. We move to the country B. And let's imagine we are moving to the country B before the 183 days, okay? This is a classical situation. Scenario maybe in April. So there are 183 days, which is basically the classical minimum number of days worldwide recognized to discriminate the tax residence between two countries. You move into country B before the 183 days. This means that you pass most of the time in the country B, okay? Now, once you move to the country B requires you to pay taxes on your worldwide income, because in most of the cases, most of the countries in the world, this is how it works. Most of the countries in the world, they require you to be taxed on residence, when you change your residence, except United States and Eritrea. But the rest of the country in the world, they require you to pay taxes when you move the fiscal residence there. And in most of the cases, in most of the countries in the world, they require you to pay taxes on your entire worldwide income. So country B requires you to pay taxes on your worldwide income based on their tax rate, okay? The problem is that you have earned some income in country A, but you're not more fiscal resident in country A. But you generated the income while you were working in this territory. And then the country A wants you a withholding tax on this. So a tax at the source, because you earn, you work, you exploit the territory to generate the income. And this works for the employee type, for real estate rental income type, and other type of incomes. So basically, the country A is demanding the territorial taxation because you generated income in that territory, while the country B is demanding you the worldwide income taxation. Here, you calculate your taxes based on worldwide income in a certain rate, and here you calculate your territorial taxation based on the taxation of not resident, because you change the residency in the country B. So you are not resident, fiscally not resident in country A, but the country A still asks you tax on this specific employee, only on this specific employee income type, and only on this specific rental income type, okay? And here comes the problem of the double taxation, because if the country B wants you to tax on everything, and the country A wants you to tax on territorial generated income, you have to find a way to avoid the double taxation. So to pay taxes in the country A at the source, and repay the same taxes declare and repay the same taxes in country B. Okay? So if you have understood exactly, if you really have this let's say, concept in mind, we can quickly go through the two most important methods that every country normally uses to avoid the double taxation. And they are basically general. There are some slightly differences, but in every single convention, either for physical person and for entities, we always use those kind of methods. There are essentially two methods that are always be used. So I'm going to explain exactly how it works. The first method, which is more common, is called tax credit method. So method number one, tax credit. So let's going back to the example, country A, and you move to country B. Okay? So the country A is asking you to tax something at the source. It means that you first pay taxes in country A on the income generated territorially, in the territory there. You pay, let's say, in taxes, I don't know, 50. Now, the country B wants you to tax worldwide, and you have to take into account the income generated in country B, of course, plus the income generated in country A, and maybe other income generated in another country that you have. Maybe you have other income in some other places. Now, country B wants you to pay something like 70. Between country A and country B, there is an agreement to avoid the double taxation, to avoid the fact that one is asking you the territorial taxation and the other one is asking you the worldwide taxation. They resolve this problem applying the tax credit method, which is it is very, very simple. So the tax credit method means that you take into account the global taxation that you have to pay in country B, 70, and then you subtract what you have already paid in the country where you had the territorial taxation. So basically you're going to do like a simple subtraction, 70 minus 50. That's it. So, which means that in country B, you only have to pay the difference, only 20. And in country, because you already paid 50 in country A. So in this way, you don't pay 50 and 70, but you pay basically 50 in country A. And in B, B knows that you already have paid 50, and based on the convention, you have to only pay the difference. This is the tax credit method. Simply like that. Of course, there are some small variants in some countries, some exceptions, but most likely this is the concept. The majority of the countries in the world apply this method. Italy is one of the countries that applies the tax credit method. So if you have the RPF taxation, let's imagine that B is Italy, you calculate your RPF taxation or your worldwide income, you calculate the taxes that theoretically you're supposed to pay, the Italian taxes, minus the tax credit of certain taxes that you have already paid abroad in a country where the territorial taxation is mandatory and there is a withholding tax that you have to pay in the country. Most likely you have to here submit the declaration tax file return for a non-resident, and in Italy you submit the tax file return for fiscal resident, okay? Putting declaring in a declaration what you have already paid in country. And now let's move to the second method, which is less used, but in certain extent it's more convenient, and I will explain why. The second method is called exemptions. And there are some variants of exemption. There is the absolute exemptions and the exemption with progressions. But let's first focus on the meaning of the exemptions. Okay, the word is self-explained, the meaning itself. Exemption means that you're exempt from the pay taxes, which is even better than the tax credit method. Let's go back to the example. So I'm going to have the same scenario here, country A, country B. In country A, I paid 50. In a country B that applies the exemption method is telling me, since I've agreed with the country A, the exemption method, wherever thing you have already paid as taxes, territorial taxes in the country, in the other country, I take into account in my declaration, so I virtually take into account the income. Sorry, let's put it in this way, without considering the amount of tax to pay. It works like this. If I have an income like 1,000 euro here earned, and here I have 1,500 euro, okay, earned in country B, and in country A 1,000, I'm supposed to declare in country B the global worldwide, so I'm supposed to declare everything, okay? So I'm going to declare 2,500 euro, because this is what the worldwide taxation means. But since we are using the exemption method, country B says, since you have already paid taxes in country A, maybe you pay 50 over this 1,000, I'm not gonna tax you on this 1,000. This is how the exemption method works. So it means that you're going to pay taxes on 1,500 because it's the amount of money that I've earned in country B, but 1,000 will be exempt from taxation in country B because it has been already taxed, doesn't matter how much, but it has been already taxed in country A. So you're going to declare 2,500 in country B because we're going to have worldwide taxation declaration, but the taxation in country B will be only applied on 1,500 because country B knows that you have already declared and taxed a certain amount, the income with a certain amount of taxation, regardless how much. It could be even zero. The fact that you have transmitted a tax file return in country A declaring this, for this country, it's enough to exclude from taxation this part of income. And as you can see here, the exemption method works very well. You know when you have several income from several countries, C, F, E, each one of these countries has a very low tax rate, like real estate tax rate. So you have 1,000, 2,000, 3,000 euro per year or 10,000 euro per year of income. This income is taxed at a very low rate and is never taxed in your country where you are residing, because this country doesn't tax your foreign income thanks to the exemption method applied for the double taxation. I hope this concept was clear. If you have any questions, you can write me at info@ESENtaxa.com. This method works very well when you want to choose a country also in the European Union where you reside in this country and you have always foreign income generated in different countries, and the country where you are living, it requires you to declare everything but doesn't ask you to pay taxes in the countries where you have generated this income because it has been already taxed there. And I can give you an example, a real one. Imagine you have a house under rent. You have one home in UK, one home in Luxembourg, but you're living in Belgium. Belgium is one of the countries that applies the exemption method. I'm residing in Belgium. I have my fiscal residence in Belgium, and I receive rental income from UK and rental income from Luxembourg. Now, the progression taxation of UK and the progression taxation of Luxembourg has the first bracket at 0%. Okay? So the first 1,000 euro, the first 10,000 euro and in Luxembourg and in UK are, let's say, declarable. I have to declare them in Luxembourg and in UK, making the tax file return for non-resident, but are not taxed effectively. I mean, practically you don't pay any taxes. You declare them all in Belgium, but Belgium, because of the exemption method to avoid the double taxation, doesn't require you to pay taxes. And you potentially be tax-free if you have set up your real estate in several countries with a lower tax rate and your fiscal resident is in the country that applies the exemption method. This works for individual and for companies. I hope, again, it was clear. If you want to more content like this, just subscribe to the channel, notification bell, and like button please to help us grow, so in this way we can release more and more informations. If you want to check if your country uses the tax credit method or the exemption method or use a hybrid situation, there are also some certain countries that normally uses always tax credit and some countries that are always using exemption. In other countries in which you have the mix of this, for example, Spain is one of the countries that uses tax credit against country that uses tax credit method, while against Belgium, for example, Spain uses the exemption method. So also countries, they are flexible. That's the reason why the convention to avoid double taxation is something that has to be always checked with an expert, with a tax advisor, to see if your relocation abroad, if your relocation in another country makes sense, mostly if you have several income that are coming from different countries. And you have to check how those incomes will be taxed based on the convention to avoid double taxation, if this new country applies the tax credit method or the exemption method. Again, in Europe, for example, Poland, Belgium, Luxembourg, Norway, Romania, Bulgaria applies the exemption method, while the rest of the country, they apply the tax credit. Now, I'll just give you a really quick checklist, but we can check together more carefully if you contact us. In the description below the video, you have our email. And that's it for today. Thank you. See you the next time.